Friends, welcome to the second webinar in the ABA Fintelekt series. My name is Shirish Pathak. I head Fintelekt and I will be your host for the webinar today. At the outset, let me thank the Asian Bankers Association for partnering with Fintelekt to help build more awareness and knowledge on AML CFT related topics within the banking industry in Asia. For those of you who don't know much about Fintelekt Advisory Services, we are a specialist in research, training and advisory on AML and CFT in Asia, and we take pride in investing our time and effort in building the skill and knowledge of professionals working in the banking and financial service sectors. We work closely with bankers, regulators, and financial intelligence units to ensure that the work we do is relevant and useful to the compliance community. Some of you may be aware that we will be hosting a regional AML CFT summit in Hanoi at Vietnam this September for the compliance community in Asia. Now, let me quickly explain the agenda for today's webinar. We will first have a setting the scene type of presentation from my colleague Arpita Bedekar for a few minutes, followed by an interview on the subject with our two speakers for today, Pramod Khandelwal and Samir Bhatankar, and then a few questions from the webinar attendees. May I now request my colleague Arpita, our Director of Research and Marketing, to start her presentation.
Thanks very much, Rish, and a very good morning from India. I'm going to provide a very brief overview of the scope and nature of the problem of trade-based money laundering, or TBML. The Financial Action Task Force took cognizance of the problem of money laundering through the trade route back in 2006. They defined TBML as the process of disguising the proceeds of crime and moving value through trade to legitimize the illicit origins of money. Trade is in fact integral to the global economy today. If you look at some trade statistics by the World Trade Organization in 2018, global merchandise trade amounted to USD 19.5 trillion and services trade amounted to USD 5.8 trillion dollars. Asia had a very large share of 30% in these global trade volumes. However, the complexity involved in trade transactions, such as different trading methods, complex documentation, cross-country payments, or multiple regulations, also makes it that much more vulnerable to being misused for illegal money transfers and for terror financing. The best known estimates for TBML today are by the Global Financial Integrity for the period between 2005 and 2014, which show that illicit financial flows likely accounted for between 14 and 24% of total developing country trade with developed countries, and trade misinvoicing was in fact the most prevalent way of moving funds in and out of the country. Now, banks, as an integral part of the trading ecosystem and as the agency nodal to the flow of money, are obligated to put in place controls and monitoring systems to identify and report suspicious trade transactions. Fintelekt's research and interactions with bankers across Asia shows that TBML has been identified as one of the top risks that AML compliance officers are currently grappling with in most of the countries. What we have also observed through our research on TBML in the region is that there is significant disparity in the levels of awareness and preparedness on TBML, not only across jurisdictions, but also among financial institutions within the same country. Typically, we find that large multinational banks or the larger private sector banks in Asia are more aware of their obligations, perhaps due to their exposure to global best practices, relatively higher budgets, and more sophisticated technology support. However, there are also banks that have very low levels of awareness and have not yet put in place any controls, such as configuring the commonly observed red flag indicators into their AML monitoring systems, or providing training to their staff on TBML, or not performing adequate trade due diligence, or maybe relying on manual alerts for trade transaction monitoring. These are actually the banks that are putting the entire global financial system at risk from money launderers and criminals. There are several reasons why we feel the disparity across the region exists. There are a few external factors. Regulatory supervision in the area of TBML is still maturing. There are a few jurisdictions within Asia which have more stringent oversight and are in fact levying penalties for lapses in the monitoring of trade transactions. The data availability within the ecosystem is fairly poor. Banks do not have visibility into the entire trade transaction. So we feel there's an urgent need for harmonization across the different elements of the trade ecosystem, like ports and customs authorities, airline shipping companies, domestic shipping companies, truckers, agents, commodity dealers, and the likes. Again, greater collaboration and information sharing among various agencies, such as the Financial Intelligence Unit, central banks, Customs and Revenue Intelligence departments, and other involved regulatory bodies, will help create an ecosystem in which fraudulent trade transactions can be detected more efficiently. On the other hand, internally within financial institutions, there is low awareness of the risks and the scope of the problem of TBML. Top management may not be aware and therefore not involved enough, and therefore invariably the necessary measures to ensure robust trade transaction monitoring, whether in terms of technology or systems or training to the staff, have not been put in place. As I said earlier, there is a significant disparity in the level of controls among different sizes and types of banks. So with this background, and as we continue in the webinar, we will ask our expert panelists about the specific challenges that banks and AML compliance officers are facing and what can be done to make TBML monitoring more effective and more efficient. So that's it from me. Thanks, and over back to you, Shirish.
Thanks, Arpita, for that insightful presentation. Listeners, if you need any more trends or analysis in the area of TBML, feel free to contact Arpita and she will be happy to help. Let me now introduce our resource persons for the webinar, Pramod Khandelwal and Samir Bhatankar. Pramod Khandelwal was formerly the Chief Compliance Officer and Principal Officer of IndusInd Bank and is currently a faculty member and senior consultant with Fintelekt and also a visiting faculty member with the Indian Institute of Banking and Finance. With over 4 decades of experience starting in 1974, first with the State Bank of India and then with IndusInd Bank, Pramod has handled several banking functions covering retail banking, corporate banking, rural banking, merchant banking and SMEs, and has a rich experience in application of banking laws and regulations, as well as AML safety norms and guidelines in the development of policies and procedures. Samir Bhatankar currently works as the head of AML operations at RBL Bank, which is one of the fastest growing banks in India. Samir has spent more than 15 years in the banking industry in India, having held leadership and technical roles in institutional, wholesale, retail, commercial, and merchant banking. He has acquired significant expertise in developing and implementing regulatory compliance and AML frameworks and policies, including those related to compliance with US sanctions programs to drive the appropriate levels of governance in the business. Welcome, gentlemen, to this webinar, and let me start off with the first question to Pramod. Pramod, what would you say are the lacunae that you see currently from a systemic point of view in identifying potential money laundering transactions in the trade finance supply chain?
Shirish, you have touched a very important aspect. Let me begin with certain key developments that have enhanced the risk of money laundering through trade-related transactions significantly. First, trade volumes have risen substantially and are continuing to rise, and globalization has widened and resulted in establishing new trade routes among various countries. Thus, there is enormous volume of trade flows, and their patterns have become more complex. International focus on AML measures, mainly strengthening of legal provisions in almost all jurisdictions, have closer regulatory supervision and monitoring has made money laundering through conventional means more difficult. Thirdly, intermingling transactions in illicit money with the genuine trade transactions is an attractive avenue for money launderers, given the complexity, variety, magnitude, and widespread reach. Trade finance and global remittances, which are integral to a trade transaction, provide ready-to-use channels to money launderers. Fifth, trade practices have substantially changed over almost 5 decades from almost entirely documentary LC-based trade. Today, 80% of trade takes place on open account basis. Again, the trade finance modalities have moved from traditional pre-shipment, post-shipment type of products to new supply chain finance modes like factoring and invoice purchasing. IT, which has catalyzed all these stated changes, has brought about revolutionary changes in trade finance procedures and also in trade document processes. The speeds of transaction processing and remittances have also increased. In the given scenario, identifying potential money laundering transactions in the trade finance business lines have posed certain challenges. We shall discuss some of these. Let's start with open account system. A financial institution undertaking a financial transaction will not have any knowledge or information about underlying trade transactions, which makes it very difficult to apply TBML specific AML methods. For example, under receivables financing, only a list of receivables may be provided or at best copies of invoices. Whereas under traditional methods, apart from invoices, other documents related to goods like bill of lading, commercial certificates were available, which facilitated better degree of scrutiny. Secondly, an established customer intermingling few transactions of illicit finance with its numerous other genuine trade transactions cannot be ruled out, and it makes the task of monitoring very difficult for the financial institution, with the limited information being at its disposal. Even where regulations require matching of trade remittances with goods flow, like bill of lading or bill of entry, due to poor or lack of coordination, it does not take place effectively. In India, the banking regulator has more recently created two portals for the purpose of matching imports and exports related goods and money flows. The customs authorities and the banks handling cross-border trade remittances are required to input the respective information and monitor any mismatches. Fourthly, processing of a trade transaction in a financial institution is done by several individuals from multiple teams. Each individual focuses on one or two aspects, providing clearances on that aspect. A holistic view is typically taken only if on any of these aspects a significant red flag is triggered. Thus, this leads to an aggregated decision rather than a synthetic holistic decision being taken. Besides, modern architecture of financial institution is built on segregation of business and operations related functions. The responsibility of detecting any suspicious transactions is typically of the operations. The operations function takes its decisions based only on the transaction data, pattern, and customer profile as available in the system. The relationship with staff, which has better knowledge and has its fingers on the pulse of the customer, lacks awareness or skills or both of AML aspects. Coordination between these two teams for AML purposes is rather poor or absent. Next, sharing of data among various players in the financial sector, among various segments like customs, law enforcement authorities, trade and commerce registry, financial intelligence unit, is at present almost absent. If the information available with all these players could be collected, analyzed, and made accessible to financial institutions for their customer and transaction due diligence, detection of suspicious transactions would be greatly facilitated.
Thanks, Pramod. Samir, what would you say are the major challenges faced by AML compliance teams in their fight against trade-based money laundering?
Thank you, Shirish, for the introduction, and welcome everyone on this webinar. Talking about the challenges, the first and the foremost is the adaptation of the TBML regulation as an enforced one and not as a necessity. Why we are saying that? Because the willingness were not shown, even though the typologies on the TBML were published by FATF in year June 2016. But we have not seen any major efforts were taken even after a decade on implementation of trade transaction monitoring by the global banks. Globally, regulators such as the Office of Foreign Asset Control, OFAC, MAS, and HKMA have started spearheading the regulatory direction on TBML monitoring in recent years. FIs have also started efforts on the on TBML since late 2016, only after serious cases were detected across the world. Hong Kong government also given a warning to all banks to adopt TBML only in May 2016. TBML were also discussed in the US in a Congress in the year of 2016 itself. It obviously says that though there were the regulations which were being published by FATF, those were not followed over a period of a decade, and that's where we say here that the TBML been considered as an enforced regulation instead of a necessity. So that's one of the foremost challenge what we can talk here about. Another challenge is to have the robust system to capture the trade data, which is in large in size, and trade or process to capture required details of the customers like their profile, beneficial owner, type of goods, volume of transaction. Say for example, a customer deviates significantly from his historical pattern of a trade activity. So here in terms of the market, monetary value, the frequency of the transaction, the volume or the goods type needs to be captured. Now considering having the trade process which is capturing such a large data in the system, it also becomes a very difficult task in the past time. So further accommodation of such trade data requires end-to-end system considering the necessity of a different data points for the monitoring purposes. Currently, processes are running separately and customer profile is not linked to the transactional database, which unable to determine whether transactions are in line of a customer profile or it is deviating somewhere. It's very difficult to determine these type of things. Thirdly is a system capabilities. Now considering the trade finance is a process which is consists of such a large data, the system capabilities or the innovations are the most wanted in this particular operational part. So considering we are still not reached to the mark where the trade process is having the end-to-end application which considers the vessel screening, a negative list screening, these type of the capabilities which is required in the system, which is not yet been observed. So these type of system capabilities also makes the trade transaction monitoring a challenge. Thirdly, talking about the regulation which is being implemented by the government, they are not yet up to the mark because in the view of encouraging international trade of the countries, governments have given a lot of relaxation to the traders, like relaxation in timely submission of a trade documents like shipping bills, bill of entry, which indirectly obviously provides scope for the money laundering. And next challenge is like timely updation of a trade customers. So now here we are talking about the updation of a customer data on the timely basis, because the trade customers are trading across the products. So capturing their business activities is the most important part of enhanced due diligence, what we call. But the very less attention being given on this particular part of the customer database updation so far, which makes the monitoring the most biggest challenge. And the last one, what we talk about the challenge is the short of a skilled workers. Trade finance is a highly specialized area of knowledge, and AML analysts dealing with TBML alerts often find it difficult to understand the complex documentation, products, and pricing related issues. Without the right amount of knowledge, AML compliance team will not be able to create guidelines and put processes in place to effectively monitor TBML within the organization. So collectively understanding these challenges, it becomes more important for us to detect them at the right time, mitigating them by implementing the systems, increasing the capture of the data points in the system, putting the right regulations, putting the policy and the procedures, which will obviously impact on having the most sophisticated systems to capture the data to follow the standard operating procedures. These type of step-by-step implementation is a requirement of the TBML implementation at this time of the year.
Thanks, Samir. Pramod, I would like to ask you, what are some of the most commonly seen TBML typologies that you have come across in your long career in compliance?
As you know, trade transactions have two dimensions, namely physical exchange of goods and services and financial exchange of money. These flows are in the opposite directions. In every genuine trade transaction, the buyer pays fair value of the goods or services that the seller sells to the buyer. So commercially, there is a monetary equilibrium. Money launderers seek to use this trade mechanism to transfer additional value in relation to the fair value of the underlying goods or services to the buyer or seller. While there are numerous typologies adopted for achieving this objective, let us discuss the basic TBML typologies. These typologies are primarily based on the following techniques. One is the technique of variation in price or quantity or quality. Another, connected with invoicing, either double invoicing or phantom invoicing. In all these typologies, there is collusion between the buyer and the seller. Let us see how these typologies work. Let us take pricing. Take an example. Say there is an export of 1,000 cell phones worth $100 each from country invoiced at a price of $200, that is over invoicing. The importer will remit $200,000 to the exporter in country A. So the exporter gets additional $100,000, which is the laundered component. This amount would then be settled by the exporter through cash payment to the importer's associate in country A. Another possibility could be that exporters associate in country B would pay cash to the importer there. The counter aspect of this could be until invoicing. If these cell phones are invoiced at $50, the exporter would receive $50,000. So the importer gets additional value of $50,000. In this method, the exporter will receive cash from the importer's associate, or the importer will pay $50,000 to the exporter's associate. Similar effect is achieved through changes in the quantity. Under shipping, that is, when an invoice is raised for 1,000 cell phones, but only 500 cell phones are shipped, there is an additional value of $50,000 for the exporter. In case of reverse situation of overshipping, that is 2,000 cell phones being actually shipped against billing for 1,000 cell phones, importer gets additional value of $100,000. Again, another modality is by variation in quantity. If 1,000 cell phones worth $50 each are shipped, but invoicing is done for 1,000 cell phones of higher model of $100 each, exporter gets additional value of $50,000. In the counter situation, 1,000 cell phones of $100 are shipped, whereas invoicing is done for 1,000 cell phones of lower end model of $50 each, creating additional value of $50,000 for the importer. Invoicing technique is for same goods transaction. Invoice are raised for 2 times, and based on those, double remittances are made, thus creating additional value for an exporter. Another modality which exporter uses is phantom invoicing, that is, without making any shipment of goods, raises the invoice for remittances. These typologies are also used for inland TBML. There are certain other typologies also which are more complex and involve multiple parties. In some of these typologies, certain unsuspecting counterparties are also used for carrying out the transactions. Let me narrate one instance. There was a Norwegian company which bought certain goods from a German company. The goods were delivered to a branch of this Norwegian company in Bhatankar. The invoice of the German company was paid by the Norwegian company headquarters through wire transfer. Later, the headquarters billed the Balkan unit at an inflated cost, adding several administrative costs. The settlement of this bill was done by the Balkan unit by depositing cash into the account of the Norwegian company headquarters, and this cash was the likely proceeds of crime. So, in this case, the Norwegian company could get the money transferred from Balkans through official channel to its own coffers. Certain other strategies could involve use of shell companies or use of front companies. Identification of the suspicious trade transactions therefore requires scrutiny of various transaction documents. Details of goods relating to price, quantity, and value. Parties involved in the transaction, shipping lines used, vessels used, etc. The usual red flag indicators used for transaction monitoring do help in identifying unusual trade-related transactions. However, given the specific characteristics of trade-based transactions and availability of more granular information during the course of trade finance, specific red flag indicators can be used for more effective monitoring. These red flag indicators, specific for TBML, mainly pertain to following 5 parameters. A. Customer counterparty related. B. Documents related. C. Goods related. D. Transactions related. E. Shipment related. There is a very large list of the specific RFIs falling under these various categories. It would be beyond the scope of this talk to go through the entire list. However, those who are interested in this can always request for it, and we shall be happy to provide the list to them.
Thanks, Pramod. Let's move now to the area of due diligence. Samir, from a due diligence point of view, what would you say are some of the details about the customer that the bank should be targeting to collect at the minimum?
So, when we talk about the customer due diligence, it is for the comfort of the bank to understand whether the customer is worth doing that particular trade transaction. Thirdly, whether the customer has that clientele or the countries which he is touching at the time of his trade transaction, which are the countries, whether they are sanctioned countries, they are non-sanctioned countries. You need to determine that what type of goods he's trading into, because some of them falls under the dual goods segment, and then it's very difficult for you to determine that it can be for the terrorist activities, or it may not be for that activity. So when you talk about the enhanced due diligence on the customer, the most important factors what it is required to check with the customer when you're meeting them is like transaction volume of their previous year, frequency of their transactions, variety of the goods what they are traded into, in which countries they have done the trade in the past, and when in which countries they will do the trade in the future, and the document verification. Why document verification is important? Because that is what is being happened in the past, or the kind of a trade transaction they have carried out in the past. So based on the document, you can also ascertain what customer has given you the information and what has been there on the paper are matching or not matching.
Thanks, Samir. Building on the area of due diligence, Pramod, let me ask you that especially when a new customer account is opened, how should the bank manage TBML risks?
Shirish, you have touched the core aspect of AML risk. In my view, the most effective mitigant for ML risk is effective and appropriate customer due diligence. It needs to be appreciated that KYC or due diligence is much beyond ID and address documents verification. At the minimum, it requires establishing genuineness of A, the customer's identity, and B, the customer's occupation. Besides, the objective of due diligence is to enable a financial institution to monitor customer transactions appropriately for determining that the customer is using its services for bona fide purposes. Thirdly, it also enables risk categorization of the customer that in turn helps in calibrating application of various AML measures effectively. In the TBML context, due diligence needs to cover certain additional aspects in respect of customers engaged in international trade. More specific, accurate, and detailed information on these aspects enhances the utility of customer profile for effective transaction monitoring and determining unusual or suspicious transactions. Let us look at these aspects. Specific information on the activity of the customer is very useful. Generic terms like manufacturing, trading are not adequate. Knowing a specific activity like manufacturing ammonium fertilizer or trading in laptops or tablets is helpful in flagging any transaction not in line with the declared activity. Similarly, knowledge about goods or services which the customer specifically imports is useful for monitoring subsequent imports transactions. At the time of due diligence also, this information can be correlated with the activity of the customer. A customer who has declared manufacturing ammonium fertilizer as its activity and mentions that it usually imports MDI, which is a chemical used for polyurethanes, is obviously not giving proper information, whether inadvertently or intentionally. Another aspect for examination is the nature of goods imported, whether these are dual goods or certain goods that are very hazardous. Take the example of aluminum alloys of certain tensile strength. These are used for manufacture of centrifuge components like rotors. Now, these centrifuges are used in the process of enriching uranium, a hazardous material. While these alloys are also used for automotive industries, medical devices, etc. Such information would determine the risk category of the customer and earmarking the customer for very close monitoring. This also applies to the goods and services exported by the customer. Again, the knowledge about the source countries from which a customer makes imports is very valuable because all outward remittances of the customer can be monitored on this criteria. Similarly, at the time of conducting due diligence, this information can be correlated with the information about the customer's imports, and it helps in determining the veracity of the information provided. If a customer declares it imports iron ore and mentions UAE as the source country, the situation calls for further probing with the customer. Mainly because UAE is not among the global exporters of iron ore. This factor is also one of the determinants of the customer's risk category, especially if the source country happens to be highly risky, particularly from terrorism perspective. Again, this would also be applicable to the destination countries of the goods or services exported by the customer. Usually, every business has a set of regular suppliers from whom imports are made. Collecting this information ab initio while opening the account helps in granular monitoring of the transactions subsequently. Again, as a higher degree of due diligence efforts, to gather information on these suppliers can be made. This will be valuable in determining the genuineness of the information provided about the customer's business activity. Similarly, the information about customers of the customer is also useful in having greater degree of due diligence. Value of turnover of transactions is the basic criteria used for AML monitoring generally. In respect of TBML transactions, information on past and expected annual imports or exports is very useful for specific monitoring rather than merely aggregate turnover value.
Thanks, Pramod. Let me move on to my final question for you. What do you think are the best practices that should be followed by banks, especially with respect to training and continuous monitoring, again, from a TBML point of view?
Shirish, I'm happy you have raised these two very important aspects. Let me talk about training first. As we have seen, TBML is among the major risks faced by banks and FIs handling trade transactions. Awareness of TBML risk at all levels is therefore very critical. I would say this is required right from the board and senior management level. The tone is set at the top. It is their responsibility to ensure that the FI is well equipped to mitigate TBML risk. And it is effectively fulfilling not only its legal obligations, but also social responsibility to keep the society at large safer. It is also important that the business unit heads have proper insights into the TBML risk so that they can take necessary measures to suitably equip the FI for mitigating it. Of course, the operating staff in various functional units, business or operations, and also the frontline staff at the branches need to be educated about the implications of TBML. Second aspect is skilled persons are essential for effective AML measures. The nature and level of skills required for TBML are of very high order. These skills are required in the business wing, that is product development, customer acquisition, customer relations, etc. Operations wing, transaction document scrutiny, transactions processing and scrutiny, transactions review, etc. And finally, but not the least, AML wing. The training programs need to cover all these organs of the FI for skill development. These programs should have both role-based tailored inputs and coordination. System-based post-execution periodical transaction monitoring is already established. Given that the global transactions take place at the speed of light, it has become important that monitoring is done on a continuous basis. A Herculean task, yes, but technology is a great enabler for this. The current need is using distributed ledger technology, DLT, artificial intelligence, and machine learning. Both those can be so designed that primary AML monitoring takes place as and when the processing scrutiny is happening by two distinct teams. This will have two benefits. One, crime or terrorist financing, there will be an opportunity to stall the transaction, thus saving any damage or loss. Two, filing of STRs can be almost in real time. That is valuable to the LEAs because of greater chances of catching the criminals. FIUs world over are becoming more and more conscious and demanding for live STRs that is given to them as soon as the transactions have happened. Today, what happens by the time STRs go, the funds have perhaps moved around the globe 2 or 3 times and passing through 50 hands. Continuous monitoring, therefore, is an important step towards effective AML regime. Of course, this does not make the periodical monitoring redundant as it takes into account past patterns. So, I may sum up, focusing appropriately on these two areas will make an FI better equipped to discharge its legal duties, mitigate its operations and legal risks. Above all, it will be contributing its might in keeping the global society a safer place. Thank you.
Pramod and Samir, thank you so much for sharing your thoughts with the audience. I'm sure many of them will have follow-up questions, and while we will take some of them now, those that we do not have time for will be shared with you so that you could respond to them personally later. So friends across Asia that are on the webinar, it is clear that for monitoring to be effective and efficient, the right enabling environment in terms of the right governance models, technology, screening, selection and deployment, and training of the AML analyst and operational teams is critical. Before I move on to the Q&A session, let me remind our listeners that we will have a specific session on TBML at our upcoming Asia AML CFT Summit on September 11th and 12th in Hanoi, Vietnam, at which we have speakers representing the Egmont Group, APG, FIs of many countries, RUSI, SWIFT, Liberty Shared, ASPI, and many other global organizations who will discuss and debate issues related to AML CFT, especially from an Asian perspective.
All right, so let's take the first question from the list of questions we've received. Samir, if I may forward the first question to you. What is the importance of vessel screening and negative list screening of trade documents? Samir, could you take that question, please? Samir, can you hear me?
Am I audible now?
Yes. So, Samir, the question
Hi,
was, what is the importance of vessel screening and negative list screening of trade documents? If you can share some light on that.
Yeah, definitely. In the recent time, the trade transaction been considered one of the safest way for the money laundering. So when we talk about the trade transaction, there are two components which are very important. The one is the documentation of a particular trade transaction, and the secondly is a volume involved in that, the country involved in that, and what type of a mode of a transport. Now, in a largely trade transaction, the vessels has been considered for the transportation. Now, when we talk about the transportation of a goods, on the document, what we get to know is the starting point or the starting port and the ending port of the vessel. Now, when it comes to the monitoring the voyage, there is very less importance being given, because during the voyage the vessel can touch upon any of the sanctioned port, and which can be detected at the higher level at the OFAC. And once it has been determined that your vessel has touched the sanctioned port, your transaction will be on the hold, being investigated. You may consider as a blacklisted from OFAC office, and your further trade activities will be restricted. So considering that, the vessel screening becomes most important, and there are the players in the market who provide such a application which helps you to track the vessels and their voyage basis upon the IMO number. So when you track your transaction where the vessel has had a voyage and have touched or not touched the sanctioned countries, it is from the documentation purpose, it is very important to understand that the vessel voyage been clear. The secondly, talking about the negatively screening, the vessels and the transactions involved ultimate beneficial owner, who are the individuals. Now, when we talk about the individuals, it's about talking about their past activities, what type of a transaction they have done, or what type of the negative activities they may be involved in. Now, such type of a data are being captured and tracked and maintained by the professional database providers. So when we have a subscription to such a database, it becomes very helpful for us to screen our each and every trade transaction, the individual involved in that, to screen against these professional databases and understand if you find any matching. In case if you find any matching, there would be a prompt action can be taken to hold the transaction or cancel the transaction to avoid the further replication of handling such a transaction and the action from the regulators or the legal authorities. So from considering that perspective, the trade transaction monitoring, having a vessel screening and negatively screening becomes the most important factor. Thank you.
Thanks, Samir. Let's see the next question. Pramod, maybe you can take this one.
Yes, Suresh.
Pramod, we have a question on open account trading. We would like to know, could you explain what is open account trading?
Yeah. Usually in trade transactions, as many of us would know, the funds and goods settlement happens on each transaction basis. That is, for every consignment sent, there is a separate invoicing, and that is paid separately. Each invoice is paid separately. Now, this had been the traditional practice, but over the years, when relationships between the buyers and sellers grow, they tend to deviate from this practice of settling each invoice separately, work on aggregate basis, what is called the open account trading. Another factor which impacts quite often, there could be both imports and exports between this two sets of two traders. That means there would be debtor and creditor to each other. So they tend to settle on a what is called gross basis and not on that is net basis and not on each settlement basis. And this creates problem in case of monitoring, because it would be easier for the banks and financial institutions to monitor against each bill of lading or bill of entry the remittances. But if remittances come net of various transactions clubbed together, then trying to match with the goods flow creates complexities. Thank you.
Right, thanks, Pramod. Pramod, there's one more question which I thought you could take. This is on objection by business teams. So there are instances when certain transactions by, let's say, a reputed and valuable customer are found to be highly suspicious. In some cases, the business team objects to filing of a suspicious transaction report, saying that the customer is genuine. What do you think should be done in these cases?
It's a very good question. I would compliment the participant, which does happen in practice, I think, almost in all institutions. The general impression carried is that once I have a genuine customer on board, then there would be no need for any transaction of that customer to be reported. Second aspect here is what is perceived is that when an STR is being filed, the STR is being filed against the particular customer, and it would immediately create problem for that customer. Now, both these perceptions are not really very well placed. There is a need in such organizations where such objections come quite often, as I had stated for the training aspect, sensitizing right from very senior level and also the business teams about how trade-based money laundering could happen. It is a known typology that money launderers nowadays seek to take recourse to the genuine established trading houses or business houses to sneak in their own transactions. Sometimes these business houses, genuine business houses, could be unsuspecting victims of money laundering transactions because they themselves would not have done adequate due diligence on their counterparties. Filing of STR in respect of such transactions is important from several perspectives. One, it's important from the legal and regulatory aspect. and that needs to be fulfilled. Second, in case such transactions happen recurringly and an institution fails to file these STRs, there is a greater risk both for the institution and the staff concerned, because in case this is considered as abetting money laundering, then rather than merely being a regulatory or legal violation of PML rules, it would attract the criminal offenses for the individuals concerned and sometimes even to the management of the institution, because once the law enforcement agencies treat this as abetting money laundering, the punishments are entirely of different nature and it would bring the institution into great disrepute. So there is a need to sensitize the staff across the board about how these things happen, and secondly, the decision for filing STR invariably in most of the regime would have been vested with the principal officer's review, and while he can consult others, but the decision and onus is on him. Thank you.
Right, thanks, Pramod. Friends, that's all the time that we have for questions today. We have made a note of the unanswered questions and we will respond to them individually over email. Also, as I mentioned earlier, if any of you would like to send us any more questions, please send it to us and we will be happy to answer them offline. Thanks again to Asian Bankers Association, especially Meg Moreno and Amador Honrado for partnering with us on this webinar. Thanks also to our resource people, Pramod, Samir and Arpita. We look forward to seeing all of you again at the next Fintelekt Customer Due Diligence Challenges and Best Practices webinar on the 10th of July. And post that, we also look forward to seeing many of you at the Asia Summit. On behalf of Fintelekt, thanks for sparing your time